Welcome back to Alpha Recap. Thanks for joining us after the close. We were watching a pretty clear risk-off day, and today we'll walk through what happened, why it mattered, and what to watch next. As always, if you have questions, you can reach us at stockalpha.ai.
Hey everyone, good to be here. The markets closed down across the board, and there were some telling winners and losers. So, what really stands out here is how the rate path story reshaped today's tape.
Yeah, absolutely. Quick headline numbers first. The S&P 500 finished the day down about 1.5%. The Nasdaq 100 was off roughly 1.75%, and the Russell 2000, the small cap benchmark, slid a little over 2%.
Big move.
It was a broad-based pullback, not a single sector collapse. Higher beta names took the brunt of it, and that tells you investors were leaning toward defense heading into the weekend.
Not what anyone expected.
So let's unpack why. The dominant theme was rate path repricing. Major banks pushed out the timing for when they expect rate cuts. That started with commentary around the Bank of England and then rippled through expectations for the US Federal Reserve. When the market thought cuts were farther away, growth and momentum stocks got hit.
Right. And the other thing is, when investors expect rates to stay higher for longer, that raises the discount rate for future earnings. In plain terms, if you were valuing a fast-growing tech company, the math just made those future profits less valuable today.
Exactly. And beyond that macro thread, there were a bunch of micro headlines that drove dispersion. Oracle disclosed a restructuring charge of $500 million, which weighed on software suppliers. Meanwhile, Cisco beat expectations and raised its guidance, and it rallied despite the broader sell-off.
Yeah, that tracks.
There were also those quirky small cap moves. A tiny photonics company jumped after a tower deal tied to AI optical interconnects. And another small name ran up roughly 11% on its catalyst. That sort of dramatic, headline-driven action in tiny names kept traders hunting for dispersion even as they dialed back broad exposure.
Honestly, I was a bit surprised by this one.
The other layer was credit and funding chatter. Filings from things like the Federal Home Loan Bank of Indianapolis and broader debate about private credit made people cautious about banks, real estate, and credit-sensitive sectors.
Right. Credit market health matters because if funding dries up or loan losses look worse, that feeds back into economic growth, which is another reason higher for longer rates feel risky for equities.
Sector by sector, tech and communication services underperformed, but there was dispersion inside tech. Cisco was a standout winner on fundamentals. Financials were mixed to lower with that credit sensitivity in the background. Industrials and materials saw pockets of weakness. Cyclicals typically underperform in a risk-off tape.
Utilities and some real estate names usually pick up when investors go defensive, but today it was patchy. There were storage and solar headlines that made certain utility names less straightforward plays.
Energy was driven more by geopolitics and clean energy transitions than a straight demand story. So outcomes were varied across drillers, service providers, and green energy names. Crypto and consumer were mixed too, more headline-driven than directional.
Short reactions. Wow. Okay, got it.
Let's talk Fed implications. There wasn't a rate decision today, but the market reacted as if the window for cuts had moved out. In simple language, when folks push out cuts, the present value of long-term growth falls, so growth stocks and long-duration assets generally got repriced.
And that repricing shows up in a few places traders should watch. Intermediate and long-term Treasury yields, comments from Fed speakers, and upcoming U.S. economic prints. Inflation, jobs, and retail sales could confirm or ease these worries.
For traders, earnings remain a real source of opportunity. Cisco showed that beat and raise names can still rally even on a risk-off day. For portfolio managers, the pragmatic approach today was to trim the most rate-sensitive and high beta positions and favor companies with durable earnings, strong cash flow, and visible guidance.
Right, and expect more microcap headline volatility too. Those thematic AI and telecom plays produced outsized moves, but they carry higher risk. Traders hunting for dispersion had a field day.
A quick historical note. This kind of rotation, mega cap tech and small caps both weakening while a few earnings winners held up, has happened around other policy repricing episodes. It's corrective, not catastrophic. The market was recalibrating risk, not collapsing.
Yep, the bottom line, markets closed down. Investors rotated away from broad risk, and idiosyncratic, earnings-backed stories outperformed the chop. That was the theme of the day.
Clear takeaways. 1. The S&P 500 finished down about 1.5%. The Nasdaq 100 was down about 1.75%, and the Russell 2000 slid a little over 2%. 2. Higher for longer rate expectations pressured growth and small caps. 3. Earnings quality still mattered. Cisco proved that, and headline-driven microcap trades produced big winners and losers.
What to watch next? Treasury yields and the curve. Fed speaker commentary. Upcoming inflation and jobs data. And the next round of earnings. If yields keep rising, expect more stress on growth-sensitive names. If yields reverse, a relief rally could follow.
All right, that wraps our recap. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening, and we'll see you next market close.